So going to our next speaker, and it's a blend here between the tax lien side and the tax incentives in Puerto Rico. So he's a professional practice, focuses on tax consequences on a variety of capital market products and strategies, including over-the-counter derivative transactions, swaps, tax-exempt derivatives, strategies for efficient utilization of tax attributes, as well as advising on cross-border tax issues. Prior to joining Mayer Brown, he was a shareholder at another international law firm and a managing director, senior tax counsel with Deutsche Bank in New York. At Deutsche Bank, he led the tax counsel function within the group tax of the Americas, and he was also editor-in-chief of Derivatives Financial Products Report, a Thomson IRA monthly publication, and recipient of the 2015 Burden Award for Distinguished Legal Writing. So I present to you the partner of Mayer Brown, Mark Leeds.
Thanks very much. We heard this morning from Janelle on the benefits of Act 20. We're going to be hearing this afternoon on Act 22. All of that only makes sense if one thing is absolutely true, and that is that you're not subject to U.S. tax on the same income. Being exempt from Puerto Rican tax is a wonderful, wonderful thing, but it makes no difference whatsoever if you're continuing to pay U.S. tax. The Internal Revenue Code contains a series of rules that exempt certain types of income generated in Puerto Rico. Okay, it contains a series of rules that exempt income earned in Puerto Rico from tax. In order to get advantage of these rules, however, certain things have to be true. Essentially, we're going to go through two sets of overlapping rules that make the tax regimen here so attractive for U.S. individuals. At the outset, it's really important to note one thing. Puerto Rico is virtually the only place that you can move without being subject to an expatriation tax. If you try to move to another tax-free jurisdiction, such as the Cayman, Isle of Man, any of the other jurisdictions which offer favorable tax benefits, you are subject to tax on the difference between the fair market value of your assets and your U.S. tax basis of your assets. Puerto Rico is virtually the only place that you can come that will offer you a tax exemption on your income that isn't subject to the expatriation tax. It's also important to note at the outset that only Puerto Rican source income is exempt from tax. That means if you're earning income from Europe, you're earning income from other South American jurisdictions, you will not be exempt from U.S. tax. The key to making this work, and we're going to go through some strategies that make the strategy, the move, worthwhile, is to be able to generate income which is going to be treated as Puerto Rican source income. The source rules in the Internal Revenue Code are among the most complex rules that we have in the code itself, and so understanding how they work and understanding how to generate Puerto Rican source income is a key to making this work. And last, I think everyone probably who's looking at Puerto Rico as an opportunity is aware of some of the abuses that took place in the U.S. Virgin Islands. And as a result of the abuses of people saying that they were Virgin Island residences, the good news is that the Internal Revenue Code now contains very explicit rules about how you become a bona fide resident of Puerto Rico, and we're going to go through those rules as well. It's going to be important as we go through these rules to understand that each one of them, it's a chain link. You've got to have each a piece of this in place in order to make it work. So at the top, thank you. These are essentially our two buckets of rules that we're going to be interested in. Who is a bona fide resident of Puerto Rico who can take advantage of these rules, and when do I have income which is going to be exempt from Puerto Rican tax? It's also important, next please, it's also important to note that special rules, very liberal rules, apply for the year of the move. If you simply get here before July 1st of a year, you may be eligible for the benefits for the entire year. Okay? And the reason why that is because two of the three tests that apply to determine whether or not someone is a bona fide resident of Puerto Rico simply do not apply to the first half of the taxable year of the move. The tax home test, which is really an office test, and the closer connection test, which is sort of, I don't know a way to say it other than it's sort of the hearts of men and women test. And we'll go through what I mean by that in a minute. But essentially the Internal Revenue Code gives you a 6-month transitional period to get it right. So January through the end of June in your year of mood are essentially exempt from the harder tests to move. And so we're going to begin by talking about who is eligible for these wonderful tax benefits that exist in Puerto Rico. After we go through this, then we're going to go through what types of income. We're going to skip the green card holder rules and go right to the rules for residency. The regulations specify 3 tests that have to be met for you to be eligible to exempt Puerto Rican source from income. The presence test, and every time I meet someone who's interested in moving to Puerto Rico, they say, I just have to spend 183 days here a year, right? That means I can spend the other 181 days, 882 days of the year in the United States. And absolutely, that's true for that test. It's not the whole picture. And there are lots of other ways to meet the presence test, some of which require a lot less time in Puerto Rico than the 183-day test. There's a tax home test, and this is the worst named test in the Internal Revenue Code. Why do I say that? I say that because it has nothing to do with your home. It has to do with your office. This test was derived for, as everyone knows, commutation expenses are not deductible. However, when you're working away from home, all of a sudden expenses which would not have been deductible if you were going to and from your office become deductible. Those rules have been imported in whole into the Puerto Rican rules, and and in the context of commutation expenses, they're referred to as a tax home. The good news is that there's a huge body of law that tells us how to meet this test. The third test is the closer connection test. And the closer connection test asks, where is your heart? And I really mean that when I say that, because these rules are written in exactly that way. When you move to Puerto Rico, at the end of your first year, you're required to file a form with the Internal Revenue Services that tells them that you moved here. That form is 8898. And the 8898 asks some very personal questions. It asks, where is your car registered? Where do you go to church? Where are your business affiliations? We're going to go through that. Where are you licensed, where are you registered to vote? Some stuff that you don't normally think of as being asked in a tax context. And the reason why is they're trying to figure out, when you say that you've moved to Puerto Rico, whether or not you've set up a tax outpost here, or whether or not you've really moved here. And so that's why I say it's sort of what's in your heart. When you say I'm going home, where do you mean you're going? I'm going back to New Jersey, where I've always lived, or now when I say I'm going home, I'm going to move to Puerto Rico. So let's start with the presence test. The presence test actually has 5 separate prongs that you can use to meet it. You can either, the one that everyone seems to know and everyone seems to talk about the minute you get here is, oh, I just have to be here for 183 days. Yep. Absolutely. That's probably the easiest way to express it, and it's so often referred to as the 183-day test. But if you fail the test in any particular year, there's a 3-year rolling average test, which is a 149-day test. You can use that. It doesn't count days in prior years with the same force that it counts current year, but nonetheless, it's another way of meeting it. A third test is that you're not present in the United States for more than 90 days during the year. So if you've got an international home somewhere else, you can actually meet the presence test being here for only 90 days if you're, not counting your number of day years, but just if you're in the U.S. for less than 90 days. A lot of people who consider this opportunity of coming to Puerto Rico are living off investment income. And if you have less than $3,000 in earned income, and many of my clients who have made the move to Puerto Rico don't have earned income, they have all investment income, constitutes the overwhelming majority of their income. It's a comparison test. If you're in Puerto Rico for only 6 days during the year, but you've been in the United States only for 5, you're going to meet the presence test. It just simply asks, have you been in Puerto Rico for 1 day more than you've been in the United States? It's simply a relative day count test for those who don't make their living through earned income. If you own your own company, and you're still deriving income that way, depending on how that's structured, you may be able to restructure yourself so that all of your income comes as pass-through income from the business and you're not paying yourself a salary anymore. In that case, you wouldn't have to worry about the 183 days and you can do this relative day count test. The last test is that you had no significant connection to the United States during the taxable year. That is probably one of the more complicated tests. We're not going to spend a lot of time on it here today, but suffice it to say, if you fail every one of these other tests and you can establish that you didn't have a significant contact to the United States after you moved, like for example, maybe you have a child at school in London, something happened, you ended up spending most of the year in the UK taking care of that child, but nonetheless you had already moved all of your possessions to Puerto Rico, you might be able to establish under the significant connection test that you had the significant intervening event that brought you to the UK, in my example, for most of the year, but nonetheless you have no significant connection to the UK, and that's why you failed the other 4 tests. How do we do the day count? The day count is actually, people love this because the days of travel where you're traveling to and from Puerto Rico count. In other words, if you just have boots on the ground in Puerto Rico, but you're not here for the entire day, it will count. And also there are other ways of doing other specific rules that get used. If you're outside, if you have a child or a parent that needs significant medical care and you're in the U.S. to get that medical care, that'll count as a day in Puerto Rico. They understand that the U.S. medical care is unrivaled in the world and that there'll be instances in which you'll want to go back to the States for medical care. If there's a disaster here too, and you get a 14-day leeway, you can count those. The flip side is, how do I count a day in the United States? You treat it as in the U.S. for a day unless you're there because of medical treatment or care. As I mentioned, you're in transit between 2 points. You're temporarily there to compete in a golf tournament. Tiebreaker rule, like I said, if you're traveling between the U.S. and Puerto Rico on a day, tiebreaker rule, you treat it as a Puerto Rico day. Pretty nice. Tax home test. For those of you who have active businesses and are considering moving to Puerto Rico, this one actually turns out to be a little bit of a challenge. And as I mentioned, it really has a misnomer because it has nothing to do with your home. It has everything to do with where your principal office is. Doesn't mean you can't have an office in the U.S., but it means that the office that you keep in Puerto Rico has to be the principal office. This is an all or nothing test. If you satisfy the day count test, if you satisfy the closer connection test, but you're operating a business from an office in the United States, and a lot of the people who make this move are in a position where they own their own businesses or they have controlling interests in their businesses, and so this is pretty real, that they can actually come and live here and still run a business that's located in the United States. You have to be able to establish that the Puerto Rican office is the principal office that you're using. I often encourage my clients in the first year or two of the move to sort of not keep an office for themselves back in the United States, if that's within the realm of possibility, because it's often very hard during to be able to establish which of the 2 offices is the principal office. As I mentioned, you get a buy on this test for the first 6 months of your move, and during that time you should be talking with your staff and the other people in your business. How do I transition, if I'm going to make this move? How do I transition my it doesn't have to be the principal office of the business. It has to be the principal office of the person who's moved. So if you're transitioning the business, your children are now in the business, you have trusted, your business has reached the point that now you've brought in professional management and you're doing oversight, then it sounds humanly possible. If the business is in the point where you need to, your day-to-day involvement and has to be there, then this is something that can really be a challenge. It just really needs to be looked at in a fair amount of depth. I'm not saying that under those circumstances it can't be met, but it's really something that you've really got to spend a lot of time thinking about, because, okay, the principal office test. Now, this is the hardest test to talk about, the closer connection test, because there's no case law on this, and it really looks to a huge number of facts and circumstances. Next slide, please. Okay. It really, it's as I said, it's touchy-feely, and this one is going to go multi-year. This is the only test that's going to look across your entire stay here. And so watch what I mean by that. Let's say you move your office here, or you're living off investment income and therefore you don't have an office, and you satisfy the day count test. You come down here for 2 years and then you go back. There's no way on God's green earth that the IRS is going to accept on face value that you had a closer connection to Puerto Rico than the United States if you're only gone for 2 years. I tell my clients that if they're thinking about making this move, that you really should be thinking about 3 years or greater. Because in order to establish that you gave up your closer connection to the United States and moved here as your home, you're really going to need to be able to establish that you were here for some period of time. A lot of the rules that relate to residency use a 3-year rule. And so I think that it's fair that a court, if they were to be looking at someone who was challenged by the Internal Revenue Service as to whether or not they really had a closer connection to Puerto Rico, would be very sympathetic to someone who was here 3 years. You can move here for 3 years and then say, look, after 3 years, you know, I just missed the States. I wanted to go back. There were things happening. There was a superseding, intervening event that drove me back to the States. But if you're thinking about coming here, you really need to be thinking that this is going to be a minimum of a 3-year move. We heard from our panelists earlier, and it was like almost textbook. You know, I came down here. I'm here now. I love it here. This is where I'm going to stay. This is my home. Those are the sentiments that have to be reflected in objective evidence when you move down here. There are a huge number, not a huge number, but there are a significant number of concierge services that are available for you that'll help you get off the ground here, that'll switch your driver's license, switch your voter registration, switch your mail, help you find the appropriate business organizations. If you're church going, you really got to let your church know back home or back in the States that you're now a non-resident member. Very, very helpful if you could join a similar parish down here as well. You got to switch your car registration. You should really, if you own significant residential, or I should say it this way, if you own significant real estate in the States that you've been using for residential purposes yourself, that should really either be put up for sale or at the very least put up for a significant rental period. If you let a home sit idle in the States that you've used as a residence, that home will continue to be considered your residence, and it will blow the closer connection test. And so it really is important that if you have real estate in the States that you've been using as a residence yourself, that you continue to treat it as though it's no longer. You got to move all your personal belongings here. I remember when I first started doing this, a friend of mine who had been through a terrible, terrible divorce came down here and shot me a picture he shot me a photograph of 2 photographs of his kids. And I emailed him back and I said, you know, I know your kids, these are lovely pictures, and why would you send them to me? And he said, I want you to put those pictures in my file. They're the only things in the States that had any meaning to me whatsoever, and they both sit next to my bed down here in Puerto Rico. Everything else that I ever owned was just a possession. This is what matters to me, and they're here next to me. And so that's sort of the sentiment that you need to have, and you need to be thinking in terms of, right, boat registrations, car registrations. And as I mentioned, the form that the Internal Revenue Service asks you to fill out after you've been here for your first year, it goes through a lot of these items, so it's really sort of important. The New York, the only instance, and maybe it's parochial because I'm from New York, as I mentioned, I'm sure you hear it in my voice, that I could think about that offered any guides, because there's no case law at the federal level when the closer connection test is met, is there's a huge amount of New York case law on snowbirds. Folks who lived in New York their whole life, buy a house in Florida, and then stop filing New York tax returns. When does that work, okay? And there is a, you know, that you're no longer treated as a New York resident, you've moved to Florida. Sort of like the baby version of what we're talking about here. And these are the factors that the New York courts have used, and I think that they would be influential to a federal court looking at the same issue, trying to figure out whether or not a U.S. person has moved to Puerto Rico. And so, you know, has the home been sold? Is the business continued in the U.S., or do you attempt to manage the business? Correspondence, safe deposit box. Julie, I mean, we've been through these factors. I hope that they speak for themselves at this point. Okay, next slide, please. Okay, so now you've listened, you've spoken to an attorney, and I do recommend that, who's familiar, and you've satisfied yourself that I've got all 3 tests done. I'm keeping a diary, so I got my day counts. I also, just back up for 1 second, I do recommend that for the day count test, that you use a credit card every day you're in Puerto Rico, whether or not it's to buy a newspaper, right? What you want is your credit card records to reflect where you are. It's always important to keep a diary, but what I find with my high net worth and ultra high net worth clients, that's sometimes not realistic to expect that they'll do that. I really recommend to use a credit card on a daily basis. Using a credit card on a daily basis will establish that you were here, right? So your credit card record will show charges in Puerto Rico for each day you're here. You can use that in lieu of a diary. I think a diary is a little bit more accepted in the tax world, but there's no reason why credit card records can't be accepted. So you've satisfied the presence test. You're convinced that you've satisfied the closer connection test. You've got your office here, or the offices are relevant because you're living off investment income. So now, why did you come, right? What kind of income is going to be exempt from from U.S. tax, okay? Interest income, not so good, because interest income looks to where the obligor is formed. So if you're holding a portfolio of U.S. bonds, you're not going to be able to claim an advantage for U.S. purposes. Remember, after you move, it's not as though you don't file U.S. tax returns anymore. You're still filing a 1040 individually, but now you've got a schedule attached to your return which shows the income that you're treating as Puerto Rican source income. And actually, from a tax lawyer's perspective, it's a really great thing, the way that the reporting works. Because if you don't, let's assume that there was no tax filing requirement. That would mean that there's no statute of limitations. The fact that you're continuing to file a 1040 and report this means that you've got the statute of limitations running. So it's really, and it's also, I think it's much better to try to do this in the sunshine, right? To try to do this in a way that's open and exposed to the Internal Revenue Service, because it creates more of a picture that what you're doing is fully supportable. Okay, dividend, and also if you're living off dividend income, if they're U.S. corporations, that's not going to be Puerto Rico source income. So all of my clients tend to be fairly bright, and they say, look, okay, fine, here's what we're going to do. We're going to take the bond portfolio, and we're going to take the stock portfolio, and we're going to stuff it inside a Puerto Rican corporation, and I'll just take dividends and interest from the Puerto Rican corporation. Won't that be Puerto Rican source income? Haven't I finessed the rules? The answer to that is if the Puerto Rican corporation that you formed is a controlled foreign corporation, which means that a U.S. person owns 50%, or I'm sorry, U.S. people in the aggregate own 50% or more of the voting stock, and we've talked about a PIC, a personal investment corporation here, that you're going to own 100% of the stock of. The source rules look through. So the answer would be no. If you form a Puerto Rican personal investment corporation or PIC, you're going to look through that. So that this is not going to be a strategy that works, forming the investment company. Okay, next slide, please. I've done a lot of work actually over the years in tax liens, and tax liens turn out to be a phenomenally interesting asset from a Puerto Rican tax perspective. And the reason why is because there is case law and rulings that specifically hold that the income from tax liens is not treated as interest. Okay? And if you're not holding a tax lien for sale in the ordinary course of a trade or business, then the income that you earn from tax liens will be capital gain, okay? And will be eligible for a Puerto Rican tax exemption. So if you've moved here and you've made a significant investment in tax liens, regardless of where the tax liens relate to, they will generate income which is eligible for the exemption. This applies even though the way tax liens are sold is via bid on interest rates, right? Some guy bids 7%, another guy bids 6%, someone bids a 5% discount. Whoever bids the lowest discount wins the bid and gets the tax lien. So they're sold as though they were zero coupon debt instruments, but nonetheless, the IRS has been 100% consistent. As recently as 1995, which in the tax law is the equivalent of yesterday, in holding that tax liens generate income which is eligible for Puerto Rican source income. So if you're interested in coming down here and investing in the tax lien business with these folks, you are going to be generating income which is eligible for the exemption, which it just doesn't get better than that, because you're essentially investing in taxable munis that become tax exempt in your hands, and the over-collateralization on tax liens is just so phenomenal that, you know, it's so rare that they don't get paid. Okay. Next slide, please. Capital gains from security transactions are sourced to the residence of the seller. Fantastic, right? So capital gains from your portfolio, including short positions, will generate income which is eligible for the Puerto Rican tax exemption. The one thing to say about capital gains, though, is for those of you who have significant investment in hedge funds. Hedge funds, I got to put an asterisk on in terms of source, because there's a series of rules in the Internal Revenue Code referred to as the office rule. And the office rule says that even though capital gains are normally sourced to the residence of the seller, if a sale is consummated through an office located in the United States, then the source follows the office. So if you have a managed account, that's still going to be sourced to where you live. But if you've invested a significant amount in hedge funds, what's going to happen is that the hedge fund investment is going to be U.S. source income, even though capital gains, which looks like it's good income, because your hedge fund manager is going to be located in basically one of three places, right? New York, California, or Connecticut. And if that's the case, then you're going to be not generating Puerto Rican source income. Even if you were to flip all of your hedge funds from the U.S. feeders into the offshore feeders, the Cayman feeder structures. Cayman feeders are still managed from the U.S., and even if, in the 0% case, they were actually managed from the Cayman Islands, it still wouldn't be Puerto Rican source income. It would be, the office is located outside of Puerto Rico. So if you're a hedge fund investor, a direct hedge fund investor, then using the Puerto Rican opportunity is not going to apply to those assets. There's a lot of special situations. Next slide, please. We talked about controlled foreign corporations, which is a look-through. Passive foreign investment companies are look-through. Interest received from Puerto Rican partnerships are look-through. No surprise there, there's a limit. Okay. Next slide. I often get the question, and a fellow comes up and he says, I'm about to sell my business, and I've been working on this business 2 generations, or for the most part of my life. I'm moving to Puerto Rico, and when I sell the business, the income is all Puerto Rican income, right? And the answer is no. Unfortunately, that is not right. If you own an asset when you come into Puerto Rico, one of 2 rules are going to apply. If the asset is regularly traded on an established securities exchange, you're going to take a snapshot of the asset on the day that you move, or if you're using a beginning of year, on the first trading day of the year, and only gain in excess of that amount will be Puerto Rican source income. You're limited. You cannot import built-in gains to Puerto Rico and treat those gains as Puerto Rican source income. You can only treat appreciation on publicly traded securities in excess of the amount of built-in gain as Puerto Rican source income. If it's a privately held business interest, or a private or a security which is not regularly traded on an established securities market, the IRS has decided it does not want to fight you on valuation. It's not going to allow you to tell it what the asset was worth when you moved to Puerto Rico. It's literally a day count. You take the number of days that you held the asset in Puerto Rico in the numerator, and then you put the number of days that you held the asset in the U.S. and Puerto Rico in the denominator, and that fraction is Puerto Rican source income. So if you've held an asset for, let's say it's your privately held business you're about to sell, and you've held that asset for 30 years before you move to Puerto Rico, and you sell it 6 months after you're here, well, your numerator is going to be 0.5, and your denominator is going to be 30.5, and only that portion of the income is going to be treated as Puerto Rican source income. It's very difficult to import assets into Puerto Rico and get the exemption. We've done a lot of wash sale transactions and other type of strategies to sell assets once the client gets here. So there are strategies, but It's not going to be, if you just simply come with the asset, you're not going to be able to get the exemption. My last slide talks about one of my favorite asset classes, swaps. Income from swaps is sourced to the residence of the payee, the same way that capital gains are. So if you're holding a hedge fund portfolio, essentially what you would do is you do a mark-to-market of it, pay any tax on any built-in gain. Luckily, last year was sort of not the most wonderful year for hedge funds, the net result of which the net asset values are down sort of across the industry. And then gain exposure through a swap. There are a bunch of banks that specialize in providing derivative exposure to hedge fund investments, and I would really strongly recommend that you use that type of strategy for a hedge fund portfolio before you get here, or other type of portfolio for that matter. So that was my romp through becoming a bona fide resident of Puerto Rico and then generating income which is Puerto Rican source income. I hope that was helpful. If anyone has any questions, I'm happy to take them. Even better. So thank you very much, and I hope that you found the presentation helpful.